Today is October 30th, 2024. My name is Ben Reppond. Thank you for watching my YouTube broadcast. I'll give you some comments and then I'm going to cover the um, what kind of insights I've got regarding the market and particularly in light of the coming U.S. election. The market continues to go up, and I think of it as it's on borrowed time. There are some fundamentals, but a lot of companies in the market are not doing well. The indexes have done well because at least the Nasdaq has done well because it is uh, tech heavy. I mean, it's weighted down by the Magnificent Seven. Of course, the Nasdaq is definitely that, but even the S&P is got a fair amount of technology in it. Many companies are not doing that well, but as we approach the election, the thing that the market typically doesn't like is uncertainty. I think there's a lot of uncertainty around the election. Who's going to win? Trump has started to pull even with, maybe a little ahead of Vice President Harris. There's the swing state issue, but it's a long ways from in the bag for either one of them. So that creates uncertainty. It's interesting to me that the market has not reflected that. There are pundits out there who are saying after the market's over, after the election's over, the market is going to tumble. I've seen several of those. I'm not going to comment on that other than I think that is a possible scenario. But I would say, again, this is why I invest tactically. If you don't, that's up to you. But I do it this way because I don't like losses, and I really don't like deep losses. Matter of fact, I'm not willing to accept a deep loss. So uh, that's. But you can think about what you want to do. But this is an interesting time. We have this every 4 years, and because things are delicate in the election, I mean, you're dealing with 5 or 6 or 7 swing states that will probably decide the election, and you could even say there's 2 or 3 of them that will actually decide the election, and kind of bellwether one way or the other. I read one where it was saying, for the Republicans, North Carolina was very important to win. And for the Democrats, Pennsylvania was very important to win. If either party, if the Republicans lost North Carolina or the Democrats lost Pennsylvania, that would probably not go well for the one that lost that particular state. So but we don't know. We got polls and we got opinions, but we don't know. So, okay, I'm going to get into this. I'll do some reporting. This past week was, somewhat negative, but not terrible. And it started out with the Monday, the 28th, as being generally a bit positive. So, again, I'm saying I can't tell at this point what direction it's going. So I'll begin with the dashboards. The first one is from last Friday, October 25th, 2024. I use on the far right, I use the indicators that are green or red, and this shows that they're going from left to right, they're above their 20, 50, 100, or 200-day moving average. There are 18 out of 28 that are green. That has dropped down quite a bit. Last week there were 22. So we're now starting to see more red come into the screen. In the yellow box, you can see the results from this past week. This 4 U.S. indexes, an emerging market, a developed market, and at the very bottom, the long-term government bond. I'll comment on that later. And so nearly everything was negative this past week. Some more, definitely more than others. Year to date is in the pink box, and you can see, and that's the way I've ordered them. So the S&P is on top, NASDAQ 100, emerging markets, Dow, etc. So basically, other than bonds, they're all positive for the year, going from 6% up to 21%. Now, this is the these are the 11 sectors that are inside the S&P 500, and again, there are 28 that are green out of a possible 44, and last week there were 39, so we've added 11 more red dots this week, and you can see on the screen how many are negative. And going from left to right on the red dot, green dot, you can see that there are more red dots in the first column than the second, then the third, then the fourth, etc. So they kind of what that's saying is basically that the market is more recently moving in a downward direction, crossing over the 20 day moving average and then the 50, etc. So um, even though everything is positive year to date, the most recent period says that it's negative. Okay, this is a chart, a line chart, showing the S&P 500. You see at the very far upper right that it ticks down just a little bit, and that's what we're talking about for this past week. A small move down, nothing big, but more, you could say that's a correction or even the beginning of a correction. So, but nothing dramatic. And I drew a black line to show the direction. The trend is definitely up over the past, say, approximately 2 years. This is the same chart. I just put it on a candlestick chart, so you can see same thing. And then that little red candlestick at the very far upper right, that's this past week. This is a relative strength chart showing the NASDAQ 100 relative to the S&P 500. The NASDAQ 100 is the numerator, S&P 500 denominator, a 30-month chart. Now, it does kind of go, it's not as clean a pattern as the previous two charts, but you can see it's still moving in an upward direction, and there was an uptick at the very end. And what that says is that the NASDAQ 100 was stronger last week than the S&P 500. So if it goes up, favors NASDAQ, goes down, and favors S&P. This is a value growth chart. Again, growth is the numerator, value is denominator. So when it goes up, it favors growth. When it goes down, it favors value. Not quite the same, but somewhat similar to the previous chart. And it has now crossed back up over the 20 period moving average. This is the NASDAQ 100 compared to the S&P 500, 2.5 year, 30-month chart. It's weekly. And again, somewhat similar, although in this case, it did favor the NASDAQ 100, but it has not yet crossed up over the 20 period moving average. This is the S&P growth companies over the value companies, the SPY-G versus SPY-V. This shows that they have crossed up over the 20 period moving average and is favoring growth companies over value companies. The S&P 500, I compare this large companies compared to small companies, represented by SPY versus IWM. 18-month chart. Again, this is crossed up over the 20 period moving average, favoring SPY or the S&P 500. The bond, this is not relative strength, it's just the pure bond, TLT. It's the long-term government bond measured over a 5-year period. I drew the black arrow to show you the direction of this, but more specifically in the short run, it's the last maybe 3 to 4 weeks is that downward move that the bonds have made, gone down, I believe it's 3 weeks, pretty much going straight down. If you can see that to the very lower part, far right of the chart, that line that moves down. definitely shows interest rates and bond yields going up, and or the perception of them going up, and bond prices going down. The dollar continues to be strong in the short run. I think this is again, I think 3 weeks here, where it has moved up nicely, well above the 20-period moving average, and continuing the upward trend that started 3.5 years ago. Gold, as I said earlier, gold had in yesterday's video. Gold continues to move up, staying well above the 20-period moving average, and showing strength. The price is up, and the chart is definitely moving in an upward direction. Enough so that they in the yesterday's video, they invited Mohammed El-Arian to comment on gold. I thought that was what a paradox that is. And then silver, same thing, has continued to go up. It's a bumpier chart. Silver is it is correlated with gold quite a bit of the time, but it's not as smooth of a chart as gold is. But as I've said before, I prefer silver because the purpose of owning silver is an insurance policy against the decline of the dollar, and silver is easier to barter with if we ended up without the dollar. You're going to need something. I prefer something of intrinsic value. And the denominations in silver are much easier to work with. Bitcoin has been kind of in a sideways move, moving a little slightly down over a period of months, but it's been pretty choppy. So for the week, it's slightly down, but really, when you look back over the last 6 months, it's generally moved in a slightly downward direction. Volatility has definitely gone up because the market has been shaky, and it went down this past week somewhat, not a lot, but that forced the volatility index, the VIX, to move up, and I drew a black arrow to show you the direction that it's going. And then I put my red mark up there to show you my number, where I think that if it moves above that number from the bottom going up, that's, for me personally, that signals a period of definitely a higher risk, and we're not that far away. I mean, that it could blow through there, in a week. Or anything could trigger it that would trigger volatility. But right now, this says to me, it implies that there's definitely risk ahead. Asbury 6, I believe the Asbury 6 indicators were 5 out of 6 were positive for the past 3 weeks. This time, 2 out of 6, not 5, 2 out of 6 are positive, indicating definitely moving more in a negative direction. Okay, next is the cross-asset relative performance chart for Asbury Research. This showing comparing one asset to another. This shows that the high beta is more in favor for the last week, the last month, the last quarter. High beta more favored than low volatility, and large cap more in favor than the small cap. The broad market more in favor than the blue chips, and the Dow, and then the technology more in favor than the broad market, the S&P. Growth more in favor than value, and the developed markets, or excuse me, U.S. more in favor than the developed markets. Excuse me. Then in the bonds, the government bonds are stronger than the corporate bonds. High yield are stronger than high quality, and the short-term bonds were in favor than the long-term bonds. And then the U.S. versus the world. I think this is the same as last week, that Peru and Taiwan were the only countries that had a stronger market than the U.S. market. The U.S. market was stronger than Canada, Mexico, Italy, Spain, France, UK, the entire Eurozone, Malaysia, Japan, India, the Pacific, New Zealand, Australia, and emerging markets. So basically just a stronger U.S. Market than most of the world markets. This is the chart that I did showing U.S. versus South Korea. The South Korea ETF is EWY, and you can see this over about a 2-year period, almost a 2-year period. This just shows you the strength of the U.S. market on a relative basis, but it also shows you probably the weakness of the Korean market. The next slide is on gold and silver, and these are prices as of last Friday, October 25th. Gold up to $27.49 per ounce, and that's down 0.2% from the previous week. Silver is holding at $33.71. It has risen quite a bit. And the gold-silver ratio is 82 to 1 gold over silver, and that favors silver as a better buy. The monster box of silver bullion, is $17,525 for a box of 500 generic rounds. That includes a $1.34 per ounce markup over spot. And that brings that price, when you look at it from a monster box perspective, to $35.05. And I got this information from my son, Preston. Okay, thank you for watching. If you have questions or comments, leave them in the comment section below. And next week, I'll be back at my home in Montana.